certainly the big one, which was the OPEC Plus meeting, which saw oil prices surge, and Brent closed just shy of $70 on Friday. I think I noted that one crude oil I could find, Duri, Indonesia crude oil, actually broke through 70, trading at $73 at the end of last week. Mike Muller, head of Vitol Asia, your thoughts on the big surprise last week?
Yes, thank you, Sean. Great to be back. We certainly see surprises from OPEC Plus here. They had space to match. The demand growth is clearly there, right? And yet, because of the sideways movement in the market, where we saw flat price pretty much go sideways in January in response to very disappointing demand numbers coming through in early Q1, that seems to have given the key member of OPEC Plus sufficient pause for thought and concern. And I think the takeaway was, until we see it, we're not sure we can act to put the extra oil in the market that everyone is saying is required. So clearly, yes, global inventories have been drawing, and the stated aim of OPEC Plus is to see that draw continue. And on top of that, with the freeze-off in the southern United States, net seeing a further loss of production to the market, literally oil staying in the ground, tens of millions of barrels. In that context, I think you did a survey last week. All but 4% of your audience in one of your polls felt that the OPEC Plus club would do nothing and the Saudis would roll over their million barrels. And that's indeed what we got. So, I mean, despite acknowledgement that in the tug of war between vaccine and virus, the vaccine ought to be winning, there are still things like hotspots in Brazil. We just talked about the Amazon variant in Sao Paulo causing 1,800 deaths in a single day there. And OPEC Plus do therefore seem intent on fulfilling their objective of further reducing inventories. And, they await a more substantial recovery in demand before they act. And their decision now, of course, makes that reduction in inventories a certainty. Some analysts are commenting that in April alone, we now likely to see 30, 40 million barrels a day less oil in the market. And as a consequence, that much more of an inventory draw. And we're accelerating all the faster now towards the stated objective of getting to a 2019 inventory baseline. And with it, all the features that come with it, which is backwardation and a perceived strong front end of the market. Now, that said, the very front of the market is still not motoring quite as much as we expected out here in Asia, because the much awaited demand surge from China is not yet a all-out surge. So people are still seeing pause for thought. But I have to remind everybody that Chinese demand is up. I mean, it is the only country that grew materially in 2020. And the Chinese plenary meeting in the last few days announced 6%, which most experts think is going to mean well north of 6%. So let's not underestimate what people are portraying as a quiet China as being less demand than last year. It is definitely still more demand than last year. So all in all, the bottom line of the decision is we're going to get a stock draw that's going to accelerate through Q2. And that's why the market's doing what it's doing. We had some phenomenal ranges on Thursday and Friday. I mean, the trading range I just sorted this down, on Thursday was $4.42. And on Friday, another $3. We went up a total of $6 in the last 3 days of last week. That is momentum for you. And no surprise that various consultants are talking about $70 plus. We're already at $69.30 and we peaked at $69.69. So that's as close to 70 as you can get.
It sure is. Christof Rühl, Senior Research Scholar, Center on Global Energy Policy, Columbia University. You got what I don't say you wished for, but you certainly pointed at that Saudi might keep that 1 million barrel a day stick in its pocket. It has done so. What is your takeaway from last week?
Well, I was surprised. Of course, was as surprised as most honest people at this point. And it's it is a very interesting thing. You could say now, as Mike just did, okay, they're at the error on the side of caution. That's the official explanation. You could take the unofficial explanation, which would say, okay, they're getting greedy. And the reality is somewhere in between, and they're maneuvering themselves, I think, into a very difficult position for the long term, because it seems like setting the system up for a little bit more volatility. Because as Mike has pointed out, what this means, it makes it almost certain that expectations will escalate towards a decline in an increase in what they bring to the market. On the other hand, they keep what is most important to them. So they drive down commercial inventories and instead keep spare capacity, which means that the redundancies which are in the system are under their control, under OPEC, more than OPEC plus, even under OPEC's control, no longer with inventory holders somewhere else in the world. They are also maneuvering in a world which is not where you have this COVID game. The COVID alley is still on, restrictions in some place, relaxations on another, although I think it resolves itself. And they're maneuvering in a world which we had discussed previously. Yeah, China is not going to save everything. But I think that these price levels will call for a reaction from shale, which was sort of not discussed very heavily. And there is a second one, other than getting inventories under control. There were a lot of statements from the big boys in shale, including especially Exxon and Chevron, which sort of toned down and said, basically said, we will not act tomorrow. But with price spikes and volatility into market, you risk something completely different, which is hedging from smaller producers. And that, of course, could become a longer-term problem. So I think I buy the erring on the side of caution story. I buy especially the attempt to bring inventories under their control in the form of spare capacity rather than inventories in the market. I buy that they are cautious about China and about COVID and all of that, but I wonder whether there is an element of volatility there. There is also, I don't know, maybe we can discuss that later when you step back a little bit. There's a great parallel between what happened with central banks and the Powell announcements and what happened with the oil announcement here, in the sense that both institutions are maneuvering themselves into an increasingly difficult position and also a difficult position to communicate in a situation where a lot will depend on communications. We can expand on that now or later.
I mean, on that point, I wanted to ask Mike, we did bring it up last week in our call, the surprise factor. I mean, there is one big difference between the Fed of money supply and the Fed of oil supply, and that is that the Fed of oil supply is surprising and keeping everybody on their toes and guessing, whereas the Fed is very clear, very continuously reminding us exactly what their plan is. The OPEC have moved from that strategy to one of complete and utter unknowns. What are your thoughts on that, and what is the outlook for that?
We knew that as soon as OPEC Plus decided they would have monthly reviews, that was going to lead to a more spot type approach to markets. But let's also bear in mind, oil markets trade 2 months in advance, especially in Asian parts. And as such, we're now talking refinery call-ups for May processing, when they're trading their April oil, which needs to be transported anything between 10 days and 30 days. So there is a certain lag factor built into all of this. And as such, it's very difficult to get that exact balance right, because the actual confirmed data has a lag of 2 months. And therefore, your trading horizon is sometimes 4 months ahead of the real data showing us what's happened to inventories, and these revisions can be major. Take the actual losses of production from the Texas freeze-offs, for example. We're not going to have real data on that until we're trading well into next month's cycle, and therefore responses tend to be, cyclical. And it is impossible to say whether OPEC Plus have got it absolutely right or not here. But it does, I'll just echo what Christof is saying. It does seem that Saudi and OPEC Plus are intent on getting stocks under control and asserting control, but also this voluntary extension of the 1 million barrels a day by Saudi has been attributed by many commentators as putting added pressure on partners in OPEC Plus to remain disciplined, because of course everyone looks at history and says, previous price spikes, that discipline fizzles away a little.
Well, certainly they got Mike, the signaling last week from, as Christof mentioned, from Exxon, from Oxy, from Chevron, that they would not be going back into the Permian basin and challenging the market share. So in a way, signaling strongly to OPEC, it's okay, you don't need to increase because we're going to take your market share away. Where do you see those two things coexisting as we go forward into Q2? And that hedging point that Christof mentioned.
Yes, the message from the oil majors, not just the American majors, is in many ways, shrinking exploration for oil as a part of the overall company strategy, no new projects, and also in the price-sensitive Permian, which people have often referred to as a manufacturing base rather than an oil price-dependent base. There has been a shift into the hands of oil majors who have historically not hedged and don't therefore adopt the same spontaneous approach as other operators there. So if you look at the rig counts, which you've been mentioning most weeks, it's still nowhere close to supporting the US returning to anywhere like the 13 million barrels a day we closed 2019 at. And therefore, there is a perceived window, I guess, where spare capacity is not there in the US. I mean, there's no such thing anyway. Abstention in the US and Canada is only ever economic, not anything else. So I think there is that period now between having had Libya come onto the market without much price impact. It got swept up in the surge of demand increasing, and the prospect of relaxation around Iranian volumes and possible rebuilding of the Venezuelan, which is going to take a lot longer, where indeed the market is telling us that OPEC Plus have control.
Christof, as you mentioned, that there is a lot of hedging going on at the moment in the US shale patch. What does that tell you about where this is going forward, and at what point does that production, do you think, start to increase?
Well, there's a lot. It probably makes sense to distinguish sort of longer-term strategy from short-term tactical moves. So on the longer term, just let me say on the outset, I don't really buy that they switched strategy just by turning to monthly meetings. They had an overly clear timetable in a situation where nobody knew in April 2020 how this pandemic and the economy and everything else would develop. So of course they had to revise it one day or another. But then with monthly meetings, that's not a strategy. It's actually a vision probably of lack of a strategy. A strategy means that you know exactly where you're going and you have a target. The Federal Reserve wants full employment and 2% inflation full stop, and that can continue forever as far as they're concerned. They develop a strategy. OPEC says we want to balance the market. Prices have been reasonably stable. That obviously wasn't good enough. They want to presumably come into a situation where spare capacity and inventories are roughly on average, and where then the market sort of style drives prices on a higher level. On the tactical side, there's a lot of things going on. I wouldn't speak of collusion, but there were certainly signals from the big boys in the shale plays that it's okay to keep with higher prices. And it's funny because we spent some time discussing previous months whether shale is dead or not. It's not dead, but it has changed because a lot of the more Chevrons, Exxons of this world are replacing the mom and pop shops. And so some of the spontaneity is getting lost, of course. But this will not hold forever. At some point, and we have now occidentally, with Vicky Muller, the CEO, going around worrying more about climate change than about shale production and these kind of developments. So it becomes, as every new industry sooner or later, much more part of the establishment and therefore a bit slower and a bit more strategic in its responses globally.
Christof, what about the impact? I mean, going into the meeting on Thursday, most notably the Indian energy minister and his spokespersons were expressing concern about the speed in which prices were rising. From the point of view of the impact, whatever the strategy is, $70 oil on the global economy recovering in a fragile year. It's one thing for the US and China to be signaling strong GDP recovery for different reasons, and one being the US is about to print another $2 trillion. But the rest of the world, India and others, burdened with $70 oil, that's a pretty serious stumbling block for economic recovery, no?
For particular regions it is, and up to us, this was very dismissive of the Indian request and just pointed to them using their inventories. But
I mean, is that a fair point? He did reference April, May, June last year. The average price of Brent over those 3 months was $30 a barrel.
The Indians stocked up apparently at 19 per barrel, but that's a fair point as far as it goes. I mean, India was not, should be punished for making use of cheap oil prices and filling inventories. And then at some point, of course, they will have to use it. But that doesn't address the underlying problem if $70 Brent is bad for economic development. It is bad for particular regions, but also the world has changed in the sense that these particular regions, Southeast Asia, including India, so are not the drivers of global economic growth. What happens to the global economy now will be determined by the big boys again, the European Union, US, China. And for them, I don't think 70 are a serious stumbling block yet, because oil's role in the economy has diminished. But number two, very important, it doesn't hit the US anymore as it did, because the US is now much more benefiting from higher oil prices than before. They're still a net exporter. So high oil prices benefit certain regions in the US if they don't collude with OPEC+, and hurt others, which are oil importing states within the US. But it's no longer the big, kill everything effect which Trump still had on his radar when he was tweeting around that OPEC should behave as far as oil prices are concerned. That was directed against an exception, an electorate with little income and big cars. But the US overall is just as much a beneficiary of rising oil prices as is probably neutral and balanced on that one. That is a big shift.
Mike, the other obviously big stories, as you noted, or Christof noted earlier, the economic data out of China. They're conservative at 6% by most analysis. I was sort of looking at the coverage of the China meeting, of the leadership there, the 5-year plan, and most were indicating the coverage that 6% was quite, bullish, and that the Chinese media were saying it was quite bearish. 6% was a low ball, but nonetheless, big numbers there. And also out of America, labor market roaring back, as the headline says. Generally very positive figures there. How do you play that going forward from the point of view of oil and energy demand looking pretty strong, but supply being constrained?
Yes, there's absolutely no question in my mind that China is going to continue growing unabated in terms of its demand for fossil fuels. And of course, it's also set out some green policies to do something about that growing dependence, because they're very much in the same boat as India. They just have a larger economy to absorb this. But yes, I mean, along with the 6% GDP growth, which was a minimum 6%, so it's not a 6%, it was at least 6%, was an energy intensity reduction target of 3%, which is interesting. And whilst there were no changes to macro policies, they're also talking about reducing their budget deficit, because it's currently running at 3.6, and they're looking to get that to 3.2. And they're looking to abolish various fees, development funds, and cut electricity tariffs, and just generally deregulate markets. And for the longer term, for the 5-year plan, because these were the 2021 targets, they have a strong drive to support innovation. I'm just reading off the summary I saw here now, looking at advancing reforms, implementing targets on greenhouse gas emission, and cutting carbon intensity by 18%. So that's in 5 years' time. And no surprise, they obviously are looking to combine their 7 regional, provincial carbon exchanges into one central registry, which is larger than the long-established EUA scheme combined. And that's just the beginning. So that's very much the tone from China. I'll let Christof comment on the US, but perhaps just a quick comment on the India retort from the Crown Prince. I mean, yes, India did fantastically well, and they have every reason to be proud for filling up those caverns they built at $19, which I think was the price for April, not for April and May. But some of that inventory, if I recall correctly, was actually put in there by Middle East producers and is owned by Middle East producers. So it doesn't all belong to the Indians. And the Indians are catching up, because they have every entitlement to sit on and retain a strategic reserve, just like all other economies. And therefore, they will probably argue that oil needs to be there for times when that inventory is needed.
Yeah, I agree that those two, the Indian and the Saudi, that sounded a bit like public bargaining.
But it's certainly, I mean, given the IEA and most projections that India is a very significant partner for the Gulf producers, for Saudi Arabia, the idea that they wouldn't have sort of heard their call, if you like, is a sort of another tea leaf to read. But Christof, outlook from the US, we had last night, the Senate finally approved the 1.9 trillion. The labor numbers coming out of the US last week looking quite positive. And bar some unknown factor with the variance, which of course is always out there, the US is starting to look quite solid.
Sorry. Yes. And at this point, exactly, I would like to come back to this example of comparing the Fed and Saudi Arabia, or the two central banks for oil and for money, which I usually don't like. But here is where the parallel is. There's also a huge risk in the US. And that risk is that people have become aware, as we discussed previously, of the inflationary pressures, which this huge onslaught of demand on limited capacity could create now, with all these COVID savings, with this huge stimulus, with people who advised Biden before now stepping out of line and warning of the inflationary dangers. So the markets have started to react, and the way they play that game is to make a big bet in the bond markets, shortening US treasuries, because the expectation is if there's inflationary fear taking hold, people will not want to hold treasuries which are very expensive and pay zero, very little nominal interest rates. So they will sell them and the yield of the treasuries will rise. In the market, in the repo market, where these things technically are dealt with, the borrowing of treasuries has reached proportions which made the real rate negative. That means there's a lot of people actually joining that betting against, that's the so-called story of the bond vigilantes, which have the potential to bring the system down. When there's a sell-off of treasuries, interest rates go up, equity markets suffer. Powell went public last week, the Fed chairman, and he was supposed to do the impossible. Towards the one hand, calm down that movement and stop this sort of rise of real yields, which looks inexorably more and more. And on the other, assuring the markets that they wouldn't overreact and that they would continue with their easy monetary policy and all that. He failed. He was talking, and the development will just continue because maybe in some situations better not to talk too much. Wasn't saying anything wrong. It was just so obvious that the inflationary danger was there, and people then vote with their pocketbook, so they sell what they don't want to hold, and that has all this economics. So it's more and more sliding out of the hands of the Fed, whether there will be a market correction or not, whether interest rates will rise or not. That's their key central policy instrument, interest rates, taking out of their hands more and more. Here's the parallel to oil as we now go forward. If OPEC Plus maneuvers itself into a position where it becomes increasingly attractive for shale producers and others to produce more and to hedge production and all of that, then you develop exactly the same kind of communications problem. At some point, you have to change your policy. You cannot bridge that spagat anymore where you say, okay, we hold our fire, we keep our powder dry, but hope that nobody else does it for you, as Novak has said. And that is a parallel where you could lose control over the price as the key variable and create at least some short-term vulnerability as markets think. There's enough oil, there's enough spare demand recovery, you're not going to soak it all up in 1 year. And therefore, there's a limit to how far prices are going to rise, and we lock it in now.
Well, on that point, Mike, I couldn't find too much in the history of oil prices at $70 a barrel that they were ever here before, when there was 8+ million barrels of idle capacity in the world. Looking forward, how vulnerable is this price recovery when the reality is that idle supply is so large?
I saw an astonishing story where I think it was Citigroup's latest missive showed that they believe that global refining capacity will be calling for runs that are up more than 7 million barrels a day versus April come August. Now, let's be clear, we have to cut, we have to cut Citi some slack here. April, of course, is the depth of refinery turnaround season when runs are low anyway, but that's nevertheless an astonishing number. And that sort of refining intake is only justified if it is underpinned by a resumption in jet demand on a spectacular scale this summer. And that's the big tug of war, because a whole bunch of the advisory consultants and banks out there still think we're going to have a tourist season in the summer. And that's clearly, we're getting closer to summer, right? And there were these famous events when in the UK, for example, the Boris Johnson administration announced that there were going to be relaxations, and they showed a roadmap back to normality. And flight bookings with Ryanair and EasyJet trebled the following day. So there is pent-up demand to travel. People do like the summer holidays, and you can only tell citizens in certain parts of the world to stay confined for so long. So there's no doubt that there will be an increase. It's just a question of what is the magnitude going to be. But yes, your point's absolutely right, Sean. If you do a correlation, a scattergram between spare producing capacity for crude oil and flat price, the spare capacity is still there, but it is concentrated in the hands of those that have shown the market for the last few months that they have discipline and they're holding to it. And if you really analyze it, of course, this underlying decline that comes with lack of investment does apply in OPEC countries and OPEC plus countries as well. So many of the smaller participants in the OPEC plus club are pretty close to what they can produce anyway. And then if you look at the actual compliance levels, which were advertised for the month of February at 124% in core OPEC and 110% across the barrel. That's because there were disruptions or production difficulties or explosions in various facilities. Super cold in Russia, an incident in Nigeria. All this contributed towards an excessive compliance picture that we already saw. On top of that, of course, you had the impact of the freeze-off in Texas and the tens of millions of barrels left in the ground there. So spare capacity is two things. It's obviously a view of the future because we are trading futures markets. The spot month of Brent is May already, right? And a perception that the things people are seeing right now will hold, namely OPEC plus cohesion and discipline.
Let's give the room a view on where we go from here, and then have Mike and Christof give their outlook for next week. It's not long ago we asked this exact same question, but the world has in some way changed since asking this only last week, and we've expanded the range of choice. But what will be the average price of Brent crude oil in Q2? What will be the average price of Brent crude in Q2? Knocking on the door of 70 right now, averaged $41 over the last year. Brent, since this crisis started, but now knocking on 70. So what do you think the average price of Brent will be in Q2? Welcome people's views on that.
You've offered us 80 and 90. Wow.
I know, huh? I mean, that's the world we're in right now.
Checking out your old charts, huh?
It's I forgot what an 8 looked like, but there it is. Christof, looking ahead the week, we would expect this 1.9 trillion package to finally hit the paychecks going out in the mail. What else next week do you think will guide this? And your call of Brent moving across 70, it seems inevitable next week.
Yeah, it could happen. But again, my main call at this point is the threat of vulnerability, because even when you think about higher oil prices, may be more important for the global economy right now than the effects that has on India, Pakistan, and Bangladesh, is the effect it has on inflation again, and inflationary expectations. It feeds into each other. So next week, a notable absent of any kind of official Fed meetings, nothing, which is always a dangerous vacuum. A lot of economic data, mostly in Europe, which probably will, be a bit on the downside compared to expectations. So who knows? But nothing which will move the world, and markets which are sort of on the edge. What we are seeing is something which I don't remember in this clarity. It's really a shift out of high tech and all these grossly overvalued things, or perceived to be overvalued things, into growth stocks, including the commodity complex, and into oil companies. That's the easy one to play that. And oil companies still being undervalued compared to what they have done in terms of cost cutting and what their profitability means at these oil prices. So I would expect that shift to continue. And on the other hand, the threat of yields on treasuries to rising to also continue, and more stability all around. And that's what I would predict.
Mike, before we give you the last word, let's bring up the result of the vote on where people think. Okay, dead heat between 41 and 41, 60 and 70. That was not the case when we did this survey just a week ago. And the fact that there's even nearly 20% tipping their hat at $80, 0 at 50, 0 at 90. But the average is moving up. Clearly, the expectation is moving higher. Mike, your thoughts for the coming week?
Yes, and I think 3 or 4 weeks ago, the majority of your audience was at 50. So how things change, right?
Yeah.
There have been a few missiles raining around the place. The Saudis intercepted a missile over Jeddah this morning. There was a nice picture of a puff of smoke in the sky, and there were another 6 intercepted on Friday. There's also some missiles going off targeting makeshift refining operations in Syria. So there's lots of rumbling still in areas that used to be geopolitical hotspots. We have a major issue in Myanmar. Obviously, the military have now had control there for getting on for a month and a half. It's shocking to see the fatalities in the streets on what are primarily peaceful protests, but the pressure from the West in particular, in terms of sanctioning the military, doesn't seem to be changing anything in the situation. And one wonders whether there's an inevitability about this just descending into what happened previous to 2011, which is an acceptance by the rest of the world that a military junta rules the country and things go on. But let's just pray for less violence there. We have the very interesting developments coming up later this month with the launch of the IFAD exchange. Last week, ADNOC made a big announcement, as sanctioned by the Supreme Petroleum Council, that all Murban crude from June will be tradable. and that was an essential prerequisite to allow for a sort of open, fully
and
tradable market.
all the crudes were released from destination restrictions.
Correct, not just Murban, but the other grades also, which will be pegged off the Murban IFAD settlements for the average of the month, 2 months prior to delivery, with a differential advised by ADNOC early in the month prior to delivery, early in M-1. So they still have a bit of discretion to exercise on those grades, but that is rather big. But it also means, of course, that just like Oman, the Murban crude, which forms the underpinning of the exchange, is going to be priced 2 months before delivery. So it does have interesting ramifications on ADNOC's flexibility to change production going forward. I'll leave it at that. And then, of course, we have a slightly stronger dollar, which is interesting because that's not normally weaker dollar sends commodity prices north, but there was a bit of a bounce in the dollar index, which some people sometimes say is a bit of a signal that commodity surges could be petering out, and maybe this is a pause for thought in the super cycle, but it doesn't look like that's the case with oil right now. I mean, let's just put it this way. On the first 2 days of last week, the market gapped down. So it closed and it opened 30 to 60 cents lower the next day. In the last 2 days, it was the opposite. It gapped up. So it closed and then Asia took it up before the exchanges opened. There's a very strong likelihood that we could see a gap by Monday, but let's wait and see.
Mike, I wanted to get your comment on that other news last week on Brent and ICE in terms of the reformatting of that contract. Essentially, if I understood it correctly, Platts on Brent looking to include WTI, ICE looking to keep it as it is. What is that signal? Is it important? Is it not?
I think Sean, you should have a whole halftime talk on this one because it is a huge subject. We can't do justice in the remaining minutes. But yes, it is a huge development from July 2022 onwards and well worthy of further debate because it can be a disruptive event in that if there is no quality premium and WTI competes in setting the price and the world switches from an FOB benchmark to a CIF Northwest Europe benchmark, there's a lot of potential differentials in pricing that need to be factored in. The initial reaction was that based on today's economics, the US crudes land cheaper than the Northwest European crudes. Of course, that's a function of so many things. And therefore, there was a perceived value change already, which does affect open interest beyond July 2022. And that's why the Intercontinental Exchange stepped in with a statement of their own to reassure the markets that they would continue finding a way of having the old methodology in place also, pending consultations. And there will be more and more on this, I'm sure, more consultations.
Yeah. It seemed like a notable announcement that sort of went under the radar with everything else that was happening last week. So we will come back to it. Mike, thank you so much for your time and insights today from Singapore. Christof from Germany, thank you for your engagement. And this, as I said, the sunlight is finally with you there early in the morning in Germany.
Need to find a better place, huh? Better background now. It's no longer dark.
Well, you'll be getting a suntan soon. But thank you guys, and thank you everybody for checking in. Have a good week, and we'll catch up to you over the coming days. All the best.
Thanks, John. See you, Christof.
Take care.
Have a good Sunday, everyone. Bye-bye.